Stock trading tips: how to overcome bad trading behavior. When it comes to investing, everybody hates mistakes like losing money on a bad investment or cashing out before the market rebounds. And the stakes are even higher for traders who buy and sell far more frequently than long haul investors and whose trading accounts may not be as diversified as, say, a retirement portfolio. Watch this video to find out some of the most widespread behavioral issues researchers have witnessed among active traders and investors and find out how to overcome these behaviors. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about how to overcome bad trading behaviors. And we all know that trading at the end of the day is the quintessential emotional exercise. Everybody talks about, we're trading with machines and with the bots and using quantitative methods, but at the end of the day, it's people, it's traders, it's emotions, it's psychology that runs the market. The first behavior, the first defect, quote unquote defect, that we've seen in our research is loss aversion. So the average person feels the pain of financial loss twice as much as he or she does the pleasure from financial gain. And traders and investors are no different. The trick then is to learn how to manage, how to navigate the financial journey, how to avoid loss, but how to manage it. Not how to avoid the loss, but how to manage it. So before you initiate any trade, decide how far you are willing to let the stock drift before you sell. And that's called having a stop loss order. So before you initiate any trade, you want to have a take profit or a stop loss order. Either or. I would say it's even more important to have a stop loss than to have a take profit, because you may not want to limit the profit, but you want to limit the loss. So decide how far you're willing to let the stock drift before you sell. All things being equal, you most likely want your winners to earn double to triple the amount you're willing to sacrifice on your losers. This is where bracket orders can help. So by predetermining your exit strategy for both profit and losses, this is what I was saying earlier, a bracket order is basically having a take profit and a stop loss. So your trade is actually surrounded by brackets, if you will. So by predetermining your exit strategy for both profits and losses, you can in actuality mitigate the natural inclination to exit your profitable positions too soon and maintain your losing positions too long. For example, say you bought ABC Corporation at $50 per share. With a bracket order, you can set a stop loss exit at, say, 48 and a profit exit at 55. Remember, stop loss exit is the same thing as stop order or stop loss, right? Take profit is the same thing as a profit exit. So that way, by having a bracket around your position, you are attempting to limit your risk to $2 per share in terms of the loss, while maintaining a profit potential of $5 per share. And that approach theoretically allows you to accumulate more losses than gains and still come out ahead. Now, let me kind of break down the bracket orders here. As you can see here on the screen, we have an illustration that this illustration is courtesy of Charles Schwab, and we are actually showing you how a bracket order works. So let's say, and we're showing this on the screen right now, a trader purchasing 100 shares of XYZ Corporation at $50 per share sets a profit exit and a stop loss exit. So this so-called bracket order allows for a potential gain that is 2.5 times the anticipated potential loss. Remember, the expected loss is $2 because you put a stop loss at 48 and you put a take profit at 55. So the expected profit is $5 per share, of course, and the expected loss is $2. So $5 is actually $2 times 2.5. So note, however, though, that there is no guarantee that execution of a stop order will be at or near the stop price. This is very important. There is no guarantee that execution of a stop order will be at or near the stop price. There are other factors that You have to look into if there is volatility, if there are issues, if there's no liquidity around the stock. You cannot be sure that you will be selling at 55 or at 48. So besides loss aversion, the second bad trading behavior is revenge trading. Revenge trading is pretty common. It's more common than you would have anticipated. It's basically meaning that, okay, you know what, you are already in a losing position, and you're trying somehow to you're trying to fight against the market. You're trying to win against the market. You're trying to swim against the trend, right? So when a trade is going against you, you may be tempted to try countering those losses by doubling or tripling down as the stock continues to drop, something known as revenge trading. But it can take months or even years for such a stock to recover, if it recovers at all. And that's much too long for most traders and investors to hold a losing position. Even worse, you increase the chances that an already bad trade will turn catastrophic. So what are you going to do here? You want to make sure you identify in advance how much you're willing to lose with each trade. Folks, the advice here is kind of similar to what I just told you earlier, which is before you place in the trade, because once you place the trade, once your money is involved in the trading game, a lot of people, unless you are experienced and trained and disciplined, you will switch your thinking from rational to emotional. That's why a lot of the planning, a lot of the preparation, a lot of the strategy must be done before your cash is in play, before you enter the position. So the advice here to overcome revenge trading, same thing. You want to make sure you predetermine how much you're willing to lose with each trade. Consider, for example, limiting your risk to no more than 1% to 2% of your total trading capital, or a percentage you're comfortable with. Some people say 5%. So all things being equal, you want to set the price, and it has to be a psychological price you're comfortable with. It has to be an emotional price you're comfortable with. Research has shown that most people are pretty comfortable when the risk percentage is in single digits. I'm comfortable around 5%. If I'm in a position and I know I might lose 5% and I might gain a 15 or 20% or 25%, I'm fine with that. 5% is great. As soon as it goes around 7.5% is a little high for me, but 10% is definitely a big no-no. I will never enter a single position where I know I might lose 10% of my money on that position. I don't care how extraordinary it is. I don't care if it's Tesla or NIO or any other star stock of the moment, right? So for example, if you are a trader with 50,000 on hand, you should attempt to risk no more than 1,000 on any single transaction. That's the 2% risk limit. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of the Awesome Sweetie Kiwi. We are still having a conversation here around overcoming bad trading behaviors. How do you, what are the strategies, what are the tactics you can use to overcome those inappropriate trading behaviors, those adverse trading behaviors? The third bad trading behavior is called shirking the blame. This is what experts call shirking the blame. So it's natural to blame losses on outside forces instead of your own oversight. However, doing that sets up for a further failure down the road. In other words, you are actually just thinking, it's not my fault, it's somebody else's. The solution lies in an impartial grading mechanism that allows you to tell how strong your performance truly is, so you're able to test your strength. So you want to compare your trading portfolio to a benchmark or group of benchmarks that will help you to see whether you're good or not so good. The most widely stock market benchmark is the S&P 500 index, but it is not always the best gauge of an individual's trading portfolio. So if you constantly fall short, it may be time to revisit your strategy or seek out the help of a professional. One thing you have to understand here is that there are people who even don't just invest, and they invest blindly, quote unquote, blindly. In other words, they just pick stocks and they don't have, and their portfolio is not actively managed. And this is called passive portfolio management. There exists an entire industry that caters to millions of investors for that. So you can just buy index funds, and those funds are just automatic. They just track a large index, and that's it. So such as the S&P or the Dow Jones Industrial Average. So my point here is that shirking the blame is a bad behavior, not just because you are actually shirking the blame on the market or on an entity that does not exist, but also you are actually, you will never learn, because you'll continue to pay tuition to the market because you're not learning your mistakes here. And so what do you have to do? What you have to do is that if you realize that after a year or 2 or 3 that you're constantly lagging the overall market, then just get into those index funds. Just buy them. So you have 3 options here. You can either revise your strategies and tactics, including your risk tolerance, your asset allocation, and diversification metrics. That's number 1. Number 2, you can consider just buying those index funds that I was just telling you about, or those or ETFs, exchange traded funds, or even mutual funds. And the third option for you is to contact a financial planner, or just outsource your investment to a professional. It could be a portfolio manager. You can open, if you have the funds, if you are wealthy, if you have a 7-digit or 6-digit net worth, you can go to those hedge funds or private equity or other alternative investments to manage your money for you. Remember also that you don't have to always invest in stocks. You can also consider other options: bonds, cash and cash equivalents. Of course, the returns, the ROI on non-equity instruments is lower than how much you would potentially make by investing in equity instruments. However, so is the risk. At the end of the day, it's all about your net return. Let's talk about negativity. That's number 4. That's this is a bad trading behavior. Number 4. What is negativity, and how does it really impact your trading? How does it come out during trading? So the length of the current bull market has plenty of traders convinced of its imminent collapse, despite evidence to the contrary. So the thing here is that don't be pessimistic just because you are don't confuse your own mindset with the reality of the market. You want to do your homework. And if a long time trend still appears to have legs, let your winners run. Even if the market turns against you, your stop loss orders and other risk management strategies can help protect your downside before you pivot your portfolio to take advantage of the correction. What I'm trying to say here is that positivity and having the right mindset is are very important, especially when you adopt a realistic view of the market, because a realistic view of the market will help you, especially when it's when things are difficult to change. For example, when you're already involved, when you're already in a transaction, in a position, it will help you not close emotionally, not close out of position because the market is temporarily down. Not really. So remember, at the end of the day, if you feel like you are exhibiting too much emotion compared with the market, it's just better to outsource the work, the investment, the portfolio management to a financial consultant, a financial planner, or anybody, or to an investment banker, or anybody else who has expertise in the field. That person can regularly check your portfolio and offer financial guidance when you need it most. One thing I also want to say here is that it's very important that you pay attention to the kind of assets you have in your portfolio. If you have a negative sort of a negative viewpoint about negative perspective about the market, this, by diversifying your holdings, by putting your money in different asset classes and different maturity levels, especially for fixed income securities, by investing a little bit of your money in stocks, bonds, cash and cash equivalents, ETFs, mutual funds. This allows you to be more relaxed, to be more objective, to be more rational, as opposed to having a concentrated position. Concentrated position means that you have, say, 10%, 20%, 50% of your entire portfolio capital concentrated in one sector or in one asset class or in one company, for example. And then you will realize that you are more emotional if you're concentrated, if you are over leveraged, if you are too exposed, if your exposure to one particular asset class or sector or security type is high, then your emotion will also go up. Now, so I've given you the 4 types of bad behaviors, trading behaviors rather, not bad behavior. Right. So we've talked about loss aversion. We've talked about revenge trading. We've talked about shirking the blame shirking, and we talked about negativity. Now, let me give you 4 tips for trading smart. 4 tips, and this will recap today's conversation. Limit your losses. So you want to identify in advance how much you're willing to lose for each trade. No more than 1% to 2% of your total trading capital, for example, all things being equal. If you think about it, 2% is not a big deal. If you lose 2%, you can still eat 3 times a day, go to sleep at night, and be comfortable. But if you start losing 10% on a single transaction, on a single position, that's pretty bad. It means that if you have 10 losses, your capital is wiped out. Your trading capital is gone. So limited to 1 to 2%. As I told you earlier, I personally, 5% is my total max. 5% for a single position. Tip number 2, let your winners run. So generally speaking, you want your winners to earn double to triple the amount of the amount you're willing to sacrifice on your losers by setting a bracket order with a profit exit at least 2 to 3 times your stop loss exit, for example. Number 3, measure your progress. So you can use your brokerage tools, your brokerage's tools and applications to compare your portfolio risk and return to a benchmark or group of benchmarks. A lot of top brokerages out there have very sophisticated tools to help users, to help clients measure how their portfolio is doing and sort of pay attention to other metrics. ROI is one, risk profile is the second one. You also have the standard deviation. So there are a couple of items out there that you can use to move ahead and know exactly whether you're doing well or not. You can also, and this is the tip number 4, you can also test your strength. You want to test your strength. You want to see how good you're doing versus other traders out there. If you can be part of an investment club, for example. You can be part of an investment group. Nowadays, there are platforms on the internet where investors and traders share ideas. They share trading ideas. They share tips. So you're just trying to see exactly where you are in terms of your trading experience, right? So you can see whether your average gain or loss, how it compares with others. You can also see the ratio of gains to losses, which is an important thing. Because if you're having a healthy ratio of gains to losses will be somewhere around 8 to 2 or 7 to 3. Not the other way around. In other words, out of 10 trades, 7 are winners and 3 are losers. That's pretty healthy. So if you have anything above that, it's fine. Everything above 7 to 3 or even 6 to 4 is kind of cool too. But everything above that is pretty good. But everything below that is really not interesting in the long run. All right. Thank you so much for today's conversation. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.